Hello there. Welcome to another weekly stock market update. I'm your host, Mark Yegge. It is May 31st, 2024. Hope you had a fantastic short week this week, and the markets are now red. So hopefully you are protecting your accounts. This is a time that you need to be a bit cautious because markets kind of short term. They turn around and go down, and so we don't want you to be going down here. So let's see what we got here. I'm going to share my screen and make this happen. How about this one? That should work. Cool. So like I said, we've got a red market, and taking a look at that, we've got 4 red lights. Primary trend is red. Everything else is red. That means that you should be really no more than 20% invested right now, unless you're just a long-term investor and you can just hang in there through these ups and downs. But there is a component to market timing that I teach in my programs that say, look, there's a time to be in the market, pushing on the accelerator, and there's a time to be coasting as the light turns yellow. And then when it's red, you should be stopped or in cash or primarily in cash and only have a few things out there, because when markets go red, and if you're watching the market right now, here in the afternoon, things are dropping pretty significantly, going into the weekend. And that's kind of what happens in red markets. And it's taken everything down right now. So hopefully you're being safe. We got 4 reds, so you've got to notice that. Taking a look at the NASDAQ, you can see the NASDAQ is, heading back down to its 50-day moving average. That's kind of the gravity that it wants to go to. And you've got to watch that, because I know it feels great when everything's going up, but we forget about these markets that go down. You can't forget about them. S&P 500, same thing, heading right for that 50-day moving average. It's a little closer than the NASDAQ. I suspect it gets there on Monday or Tuesday. And then we have the Dow that went through the through the 50-day moving average, and has been trading now below it. In fact, if you look at it for this whole last month, most of the month has been under the 50-day moving average. We did have a gap up here where it gapped up a couple weeks ago right in there, and it filled that gap over the last couple days. And gaps get filled if you ever watch anything that I'm talking about. In fact, I've got a new video coming out in the next couple days that'll show you that gaps get filled. So watch out for that. All right, let's keep going. Okay. Here we have the New York Stock Exchange is under the 50-day, and it's trying to get back to the 50-day. I suspect it's just testing it. But, I think when in the beginning of a red market, there's a lot more gravity than there is lift. And so the gravity is going to probably pull things down unless we get some kind of news about the Fed lowering rates or something. And that's probably coming because we have an election coming up and everybody wants to get reappointed and reelected. And then we have the VIX, which is now making its way back to the 50-day moving average. So it's reverting to the mean. There's a lot more panic going on in the market, but not a huge amount of panic. I would just say concern. So this doesn't feel yet like a really bad red market, just, typical red, time to kind of, go to the shore. And then when it gets green, you can go back out and swim again. The Dow Jones Transport Index, if you know the Dow theory is that the transports lead the market. In other words, if people aren't driving goods around, if they're not delivering things, if they're not sending things across the oceans, that means that the companies behind them that make the goods are in trouble. And so this is kind of a leading indicator. And you can look at this chart and you can see it is kind of a leading indicator. It's been going down, and so are the indexes, and that's why we're red. I'll go through a few stocks. We went through a lot and had a great discussion on our mastermind call. But Apple is beautifully up, and it's kind of holding steady at the 190 area as it had a little gap here, but it made this move up, and it's kind of holding it. I guess it's going into the Consumer Electronics Show or their Worldwide Developer Conference or one of these unveilings that they do, and they got the iPhone 16 coming up in a month or two or whatever it is. There's always some reason for stocks to go up. But anyway, we've got interest in the stocks. I would love to see a little bit more volume there, even though we're not seeing it. But the stock is, kind of staying above its 50. It's staying above its 200. It's starting to look like it's going to do a golden cross here in a week or two right there. We'll see if all that happens with Apple. But, Apple's been tough for the last 3 or 4 months. And like stock markets do, they go back the other way. It's kind of like a pendulum. They always kind of correct. NVIDIA, you could see I've marked a couple of gaps on the chart, but NVIDIA, broke out on earnings last week and has been doing really well. It left a couple more gaps on the chart. But, I suspect there's a little island pattern going on that needs to kind of get corrected up there. And they're talking about a split. Stocks generally will do well every couple of years when they split. When they split too much, it kind of collapses the foundation of the stock. I don't know if that's happening with Nvidia. It could be. Nvidia is not doing well today, and it's not doing well after topping there on some decent volume. Now it's coming back the other way. I think it wants to go back to this level, which is about 960. And I think, this 662.48, although it seems really bizarre, could be in the charts, right? No pun intended. Could be in the cards, I should say. All right. Super microcomputer has broken a little uptrend that it had going on, this little thing right here. And so now it probably wants to go back and hit that 671. If you've been listening to my market calls here, I talk about how SMCI wants to go between about 700 and 1200, and that's kind of exactly what it's doing. 671 being not quite 700, but anyway, that's what it's doing. Just banging around in here, getting rid of sellers, picking up new buyers, and it's got to hold this level in order to be viable. And maybe long term it's better. Amazon is selling off under the 50-day moving average today. Not too much to worry about with Amazon overall, but I think Amazon wants to at least go touch this little gap that it had, this little high hammer candle right there. And I think it's going to do that today. It looks really close to that in that area. Nothing to worry about with Amazon yet, but there is that 200-day moving average out there that, it's going to want to get to at some point. So who knows when that is? I don't see any news events coming up on Amazon. So it may just, with this red market, just kind of sell off as people take their money and put it into other things. Who knows? But that's what I see. ServiceNow has been doing poorly over the last 4 days of trading, unfortunately. And it's gapped down a couple of times over the last couple of days on high volume. This stock is in trouble for some reason. And I think it probably wants to see this $608 level right in here, and it's not too far from that now. I mean, just a week ago it was almost at $800, and it was at $800 a month ago, and now it's we're talking in the 600s. ServiceNow is in trouble, and it's in trouble on high volume. Be careful if you're in ServiceNow. On Semiconductor has been in trouble all year. It's been trading under the 200 all year. It's over the 50, but it appeared on my short list today. And if you're a subscriber to my newsletter called Insider Tips, I'm going to give you that short list on Monday morning or Monday, or early this week, because having a short list, if you're in a short part of the market, is a good way to make market when things are red, and it's a good way to make quick money. I don't recommend you short unless you know what you're doing and you seek advice, and this is not advice and blah blah blah. This is education and information, but there's a way to make money on the short side when things are weak in the market. And I don't know, this could be a long-term weakness. I don't know. We don't know until it develops. But on Semiconductor, there's a gap on the chart that wants to get filled right there at, $62 or whatever that is. And then there's a 50-day moving average that wants to be tested. So that's what I see on the chart for Amazon. AMD made its little top up here, and it went all the way down to 141. Didn't quite hit the 200-day moving average, bounced up, and now it's testing the 50. I think that's a healthy test. But, it's been testing that 50 an awful lot in the last 2 weeks. And I would love to see it kind of break from here. It probably is going to take a green market to get us out of this thing on AMD. Meta, if you listened to me a couple of weeks ago, I talked to you about, I talked to somebody, maybe not you, about what I see on the chart. I think Meta's in trouble. In fact, I put a video out on it. And I said, is this stock in trouble? I think that was the title of it. It's about 3-4 weeks ago. Anyway, I saw these gaps on the chart. And look at this one. It's gotten filled, right? It's going to get filled. But that's not the one I'm talking about. This is the one that I think is going to get filled, and that's just under $400. And so Amazon, I think, is headed down, and it's not selling off on a lot of volume, which was one good thing about it. Excuse me, but I do think it wants to go lower, and I think it wants to at least go down to $400 and see what's going on down there. Ironically, that happens to be the same level, or coincidentally, I should say, as what that 200-day moving average will be. Facebook has been a very strong stock here. I keep saying maybe Amazon, but it's Meta or whatever the name. They change the names on these companies. It doesn't make any sense. Google is still Google. It's not Alphabet, right? I don't know. Anybody calls it Alphabet. Here we are trying to call this one Meta. Nobody's doing it. Same thing with Twitter. Anyway, I digress. So you're going to see this go to $400 and test that 200-day moving average. That's what I see, and I've been seeing it for a month, and now maybe you'll see it. Hopefully you're short in Meta, but if people have been asking me if they should buy it, I'm like, no, don't buy it. It's got It's a dog with fleas. JP Morgan, you know, the banking sector, if the Fed raises rates, is in trouble. If the Fed lowers rates, which is the tendency overall, everybody's been saying there's 4 cuts, then there's 3 cuts, now there's 2 cuts, now they keep moving out the cut, you know, but the stock doesn't seem to see that, because I always say that the Fed is not doing QE anymore, quantitative easing. What they're doing is the Treasury is now printing T-bills to buy some of this short-term stuff, which is creating more problems for the US and our dollar and all that kind of stuff. But we don't see it because we're like, what's the Fed going to do? Oh, the Fed's going to keep raising rates, or they're not going to lower rates. And that's the headline. But the headline doesn't matter anymore. It doesn't matter what the Fed is doing. It matters what the market thinks the Fed will do, or market thinks the market needs to do. That's what's going on. And you're seeing that in the charts of the banks. So you can look at that one. You can look at Bank of America. They're kind of the same chart. They both look really good. I'm going to leave it there. I've talked too much, and I thank you for your time and attention. Let me just tell you, I hope you have a great weekend. Thanks for joining me. As always, if you want to get some insider tips on that free newsletter, you can certainly join. There's a description down below. And thanks for being here. Take care. See you on the next video.